Why investors say no to funding your startup after you've pitched them. In this video, I'm going to go through the reasons investors say no so you understand, because when I work with founders, a lot of times they can get pretty emotional or upset, or they don't understand why the investor particularly says no, because not all investors are going to give you the direct feedback. So sometimes interpreting what investors say and how they say it is important, and to give you a framework on what to do about it. And a lot of times the things that founders think are the reasons are not really the reasons. So I'm hoping this video gives you a great foundation, a point to start in processing investors' feedback, especially when you get a no. Okay. So here's how we're going to do it. We're going to walk through, and it just so happens they all start with the letter T. Okay. So the first is investment thesis. Right out of the gate, every investor has a thesis. It may be formal or informal. An investment thesis is pretty much a hypothesis on what's going to make the best investment. So some investors say, I'm investing in early stage startups. Some investors say, I want to be in a particular type of industry, a type of technology. Maybe they're into crypto or they're into health tech, something along those lines. Some investors are in CPG, consumer packaged goods, and some investors say we avoid CPG like crazy. Now, the more sophisticated investor, if they're a fund, a micro VC, an accelerator, they will share with you what their investment thesis is. And this is the industry we're looking for, et cetera. And they come in all different shapes and sizes. But then there's informal, where it's simply based on founder character. Some investors say, I want to invest in, underrepresented, underserved minority founders, et cetera. I don't care what industry it's in. It's all falls under the category of investment thesis. And so sometimes you're going to get a no because it just doesn't fit in the investment thesis. We had to say no to some crypto ventures, even though I'm really big on crypto and blockchain. Yes, the market's embattled right now. But, at the beginning of the year, our investment committee, we just decided, what, we think, the entire market is just going to kind of go sideways, not really interested, not seeing some opportunities. And so it's no to crypto-based, ventures for this year. So our investment thesis for the year. It can change over time, but don't worry, because there's lots of investment theses out there, and you'll eventually find the one that fits what you're trying to do. The next reason you get a no is TAM. This stands for total addressable market. If the thesis is that we need to be building or investing in future unicorns, your TAM, total addressable market, better be in the billions, right? Versus the local market, and your TAM just might not be big enough, right? Now, your TAM might be too big. Some say, this is too risky. You're going to need too much money. We're not interested. We're looking for, startups that are more local. And you're talking probably more about angels or small business investors. They don't want a huge TAM. They just want something that's going to work for something local. And typically, though, if you're talking to VC, you're talking to professional capital, they want TAM in the billions, because they want to know that if you can accomplish it and you're reaching an underserved market, which has got a big, painful need, you're going to grow so fast, you're going to be making hundreds of millions of dollars a year, which makes a unicorn, which is $1 billion valuation, pre-IPO, all that good stuff. So your TAM just might not be big enough. I've had founders sit and talk to me. I tell this story often. I remember sitting with a founder, and we were in a coffee shop, and he told me straight out, they raised millions of dollars, and then they went out and they just realized later, too late, in fact, that their TAM just wasn't big enough. There's just not enough people who are going to buy their solution. It's not a big enough market for the time being. And therefore, they had to go back to the investors, say, who are looking for a 10x return, and say, are you okay with a 2x return, a 2.5x return? And that's an uncomfortable conversation, going to get awkward. So sometimes investors will say no because your TAM is not big enough. Next is tech. You have to understand that tech is the asset. So if you are not building your own tech, or you don't have the capacity to build your own tech, you might get a no from investors. Let's say you are using WordPress, right? You can't own WordPress, right? If you don't have the ability or the plan to build your own solution after, let's say you use WordPress as an MVP, an investor is going to say no. Or your tech might not be original enough, or you might be building something that's already been done multiple times and is commodity at this moment, and it's just off-the-shelf software, right? So your tech could be a reason that investors say no, especially if you don't have a technical co-founder or you're not a technical person yourself. They may say you don't have the capacity to build your own tech. And that's a major consideration because tech is the asset. Because think about it. If you're not around in your startup for the long period of time and you're not at the helm, like let's say you're in a service provider industry and you're the one delivering the services and you're not using tech, why would they invest in you? Because if you decide to leave, well, the company's not worth anything. So tech is the asset that continues to grow, that can scale because software eats the world and it's got better margins and all that good stuff. They're going to see tech. And so certain investors have a thesis, and if you got a big enough TAM, they need to see that your tech can actually reach that TAM in alignment with their thesis. So that's a reason investors might say no. Next is the team. So investors will look at your team and say, does this team have the chops, the domain expertise, the passion, the background? Are they embedded? Are they immersed in the problem solution that I can trust them with my money and I can trust them to grow the business? A lot of times you look at a founder who's trying to develop a startup that has nothing to do with their background. So they started in one and they've gone in a completely different industry and they say, now I care about, let's say, climate change, but they've had no experience or exposure to climate change. Well, that's going to get you a no because, all right, you might have a great idea and a solution, but can you actually pull it off? And that's where a lot of times they'll look at maybe your advisors and different things like that. But team, going back to the tech, you might not have that technical co-founder. You may be just using dev shops and you can't attract a technical co-founder. They may say no until you find a technical co-founder or different things like that. So team is going to be very important. They'll look at the configuration. Just talking to some founders today and a founder and talking about how do you get the right team together. Well, one of the reasons that accelerators like Y Combinator will ask you, what have you done with your co-founders outside of this startup? They want to know the team configuration. Do you have the chemistry? Because one of the main reasons startups implode is because of co-founder issues. And I've had a startup completely implode because of co-founder issues, just to have the wrong co-founders. It was one of the most traumatizing, horrific experiences. And, you know, people lost hundreds of thousands of dollars because we as a team couldn't get our poop in a group, to use that expression. And that was sad. So it's unfortunate. Next is traction. All right. So let's say it fits the thesis. The TAM is great. The tech is great. Team is there. But then investors want to see you de-risk the investment by getting traction. So they'll say, so come back to us when you've reached $50,000 in revenue, or you have your 100,000th user, okay, your 100th user even, or you get the first person to pay or different things. So they're going to put you through the test because you have to understand there's no new problem under the sun. There's no new solution. You know, you throw a rock. It's the reason it came up today in one of our office hours. The reason I don't sign NDAs because I'm meeting so many founders who are trying to solve similar problems in the industry that I'm not going to sign an NDA because you can't come after me just because I talked to another founder solving another problem. You know, it's just that's, you know, how it works. So multiple founders and startups may be solving the same problem. So how does an investor know which one to invest in? Well, it's going to be based on traction. Which one can get the most momentum and velocity as far as revenue or a certain meaningful metric to prove that everything is lined up and this is the startup that's going to be the best bet for the investment for the type of returns that they're looking for. So traction is going to be important. And a lot of times investors will say, you know, come back to us when you have a lead investor. And sometimes this vexes founders. Most of the time vexes founders. They don't know what that means. What it means, part of the traction is, can you convince another investor, right? A lead investor who's been looking for the traction, right? So if they're going to use other investors as a signal because most investors, they never want to be first, but they definitely don't want to be last. So they'll use another investor and they'll say, okay, that's the reason the first investor always gets the best terms, by the way. They'll say, okay, if you've convinced another investor, you have all these things plus the traction, and getting that investment and the amount of investment that you get is a sign of traction, right? In how you're doing, because it's kind of the culmination of everything coming together for your startup success. So traction is another reason that they're going to say no. Finally, it could be timing. Everything lines up, but the fund says, you know what, we don't have any dry powder to allocate, or, you know, it's been a really rough month, or all that stuff. Please keep us in mind, etc. Timing is just not right. You know, someone could be having a bad day, or the investment committee's out of the office, or they just wrote a check to another company, you know, in the similar thing, and they wish they would have, you know, seen you first, but, you know, they're going to roll with it, etc. Yeah, that's just, you know, how it works. Timing can be an issue, and this is not your issue. Like, this is not a problem that you created. It's just bad timing. Other things could be timing in the marketplace, right? It's just not a good time to launch. You know, I've shared stories about how I've been in startups that have launched like a decade too early, and a decade later, I see another startup do millions of dollars and raise copious amounts of investor capital. I go, yeah, timing is an issue. We were barking up the right tree. It was just the wrong time to do so. So how do you address all these? Let me go through the list again. So first, research the investor's thesis. You can track this by looking at their past investments, or they've published it, or ask them. If you're having conversations, just say, if you could articulate your investment thesis, what type of startup are you looking for? And get to that no as soon as possible. I've had founders tell me, Ed, the best conversations I've had with investors is after we realize that we're not a fit, we don't fit their investment thesis, and then they give us a ton of advice, which is great. So getting to know as quick as possible. TAM, learn to calculate TAM, SAM, SOM, figure out and do your research on whether your TAM is big enough and how that works. A lot of founders go, oh yeah, we're in a $1 trillion market, but they don't understand the market is segmented, and you may be servicing a thing that's only worth $10 million. Like, that's an extreme case, but research the TAM and learn the difference between top-down and bottom-up TAM. If you can calculate a bottom-up TAM, and that's worth billions of dollars, that's even better. And I'm not going to go into that. I plan to do another video in the future about top-down, bottom-up TAM, but there's lots of resources. There are a lot of resources out there that will tell you how to calculate bottom-up TAM. Tech, well, that's simple. Focus on the tech, right? Figure out how to do something unique. If you have to outsource it, get a plan, get a technical co-founder, all those things. Figure out, do your research on whether you're building something original or not, and figure out how to create some original tech that's going to stand alone, that is a defensible competitive advantage for your company. Team, be brutal about your team. All right. Think about it. Like, I follow lots of professional sports. A lot of times founders will get together and they'll say, oh, we're friends, come in, you know, take 50% of your company. Let's make you the CTO, or, you know, the CEO. And people just aren't qualified, and that's going to wreck you. And if you start giving away your stock, a savvy investor is going to make you defend your cap table and say, why does this person have 25% of your company, but has all the same skills as you? Oh, we were friends in college and I really like them. That answer is not going to fly. And they're going to sniff that out right away. So be brutal about your team, like a sports team. They're brutal about it. Like, you know, you could have the best performing, you know, player, but if the salary doesn't fit, or they had a down year, or they have injuries or different things like that, they get cut, right? So don't treat your team like family, okay, with all the personal things, and you feel bad when someone gets voted off the island. And don't treat like a willy-nilly like company that you're throwing together and it's a shotgun team that you put together. Treat it like an actual sports team where you're trying to win a Super Bowl, or, you know, the World Cup together, and all the brutal decisions that have to go into play, especially when it's based on performance, chemistry, and all the other factors. On the flip side, you can have a team member, like on sports team, they're not the greatest performer, but they get brought in because they've got experience and their leadership presence in the locker room, or they can mentor younger people. And so those individuals get brought in as well. So that might be the type of team that you're building. Now, remember, not everybody has to be a co-founder on the core founding team. You can have board of directors, board of advisors. You can have all different people. You can have freelancers on there. So show investors that you know how to build a team and you've thought things through. Traction, straightforward. Go get traction, right? Just traction says it all, speaks volumes that you put everything together, focus on traction, right? When I, do a startup, what I do is I do it like a traction prediction graph, and I go, okay, I'm going to start here. And if I grow my customer base or I grow sales by 10%, every week over week, in 3 months, I should be here. At the end of the week, I should be here. And if I'm not, what am I doing wrong, or what needs to change? Like, what is this data telling us, right? And don't beat myself up and say I'm a failure. I say I didn't do it, even despite my best efforts. What am I learning, and how can I iterate or possibly pivot the company to get me the traction? Get obsessed with traction. All right. I've told, my co-founders, I'm not raising any more money until we get more traction, because the more traction you get, the better deal that you have. And traction is a sign of product market fit. And to the chagrin of co-founders in the past, remember I was telling horror stories about, the wrong team. Well, they're like, yeah, but I need money and salary. And I go, I'm not going to risk that. I'd rather live on ramen noodles than have this conversation saying I wasted your money because I couldn't figure out how to get product market fit, i.e. traction. Okay. And then finally, timing, stay relevant. Keep your ear to the ground and just know, and don't take it personally. Sometimes you catch lightning in a bottle. Like you look at Zoom, right? Zoom was building company over years and years and years. And then the pandemic hits, and then pow, it's the perfect time for Zoom. And sometimes that occurs. And so things are out of your control. So there's the locus of control. If you have an internal locus of control, you can, focus on making sure that you match the investment thesis, you're reaching the right TAM, building the tech team and the traction. You can't control external factors such as timing, right? But at the same time, don't get so mad. It's like, okay, everybody in crypto, beginning of 2023 or the end of 2022, things imploded and, everybody soured on crypto investments. I get it, right? That's crappy. And we can grumble all we want about all the, bad actors who've screwed it up for the rest of us. But that's just timing of it, right? And so you then go to your internal locus of control, say those factors, it's not responsible for those people who screwed up the crypto industry and gives a bad rap. But then what you do is you say, what can I focus on internally? And that's these other things on the list. So that's the reason investors say no. Hopefully this video was helpful. Think this through. Just take a straightforward approach and separate yourself from your emotions and work through these T's to understand why investors say no. Hope this is helpful. Join us, as always, at startups.com if you want to have more conversation about this. We're always giving office hours and workshops related to this conversation. And leave a comment and, ask a question if you're interested in other topics. Your feedback is always helpful. Thanks for watching this video. See you in the next one.